Welcome to the Startup Innovators podcast, and I've got Matt Venturi in the house today, and I'm totally psyched because I love FinTech and one of the most exciting spaces that there's out there, and Matt's doing something completely unique that could potentially affect every one of us individually. If you've ever been dying to get shares in that hot IPO and you feel like you're the last guy on the train, well, Matt's been trying to tackle this problem. We're going to talk all about it today. So how you doing, Matt?
Doing great, Tim. Thanks for having me today. Great to see you.
That's awesome. So I like to do a quick bio, Matt. I hope I've got it right. But we have known each other off and on for about 20 years, all through your investment banking days. So this should be fun. So Matt Venturi is a founder and CEO of a startup called ClearingBid, whose goal is to essentially democratize IPOs. We're going to talk about that, which is rather than letting institutions just dominate allocations, Matt's vision is to open IPO access up for every potential qualified investor, and we'll go what qualified is as well. Essentially, leveling the playing field that's really been tilted towards the few insiders and large institutions in the past. Before starting clearing biz, I just alluded to, Matt had been in the investment banking industry for many, many decades as an investment banker, as an advisor. We first met, gosh, decades ago, working for Houlihan Lokey. I think Tracy Albertson had introduced us at the time, or
Yeah.
Walter Crutton. I think met Walt at a party, and he suggested that we connect. And so I know after you left Houlihan Lokey, you went ahead and started your own advisory firm, which you've been doing for many years before you tried to tackle this tech startup idea, which is really, really neat. So here's what I'd love to let's start off with clearing bid because I think the idea is always so prevalent. I mean, I remember when the dot-com days were booming, and in the early days, people felt like that was if you got an IPO allocation personally, it was almost a printing press. Of course, there's a printing press that the value of those dollars declined about 90% about a year later. It seemed like it, and the IPO bust. I think that started off this idea of if only I could get something at the price that a large institution is when the IPO initially goes to market, I could be part of that bump, and then kind of have that early success that was elusive to most individual investors. Even if you were what we call an accredited investor and met these high standards, it was still very, very difficult to get access to an IPO allocation unless you had a friend that was at the company and they put you in and allowed you to be part of the allocation that maybe the brokerage firm that was underwriting the deal.
The friends and family.
Yeah,
Yeah.
yeah, the friends and family. So, love to start off with if you could define what the problem has been historically, maybe where other players have failed, and where you believe you can solve this problem and provide this democratized access for every man.
Yeah, that's a great question, Tim. So, today, and this is kind of going back to my background, and the reason why I started this is really the opportunity to level the playing field and take and break down the barriers of I call them silos on Wall Street. Wall Street is really compartmentalized by different disciplines. You've got the sell side on one side, which is Wall Street, and you got the buy side on the other side, which are the investors, the institutional investors, the VC investors, et cetera. On the sell side, you've got sales and trading, you've got research, you've got investment banking, you've got syndicate, you got the retail versus the institutional side, and they're all conflicting. And this is why I call them silos, because there's a huge amount of conflicts. And it's really built around, quite frankly, servicing the bigger institutional accounts to their benefit and the detriment, I hate to say, of everybody else out there. So the IPO market isn't any different. And what happens today, back to your question, is you have a book running manager who's the lead manager on an IPO, and it could be a bond offering, it could be any kind of primary new issue offering. And what happens is that lead manager really controls the whole offering. They, at the end of the day, yeah, they go on the road show, they market the deal, but they end up ultimately pricing and allocating those securities to their accounts of choice at the expense of really 99% of the other investing universe and their interest. And so what happens is there's no way in which the investing public at large, and this includes institutional investors that aren't part of this club, and their inability to be able to place an order for a new issue. And let's talk about IPOs for a minute. So consequently, today, that lead manager and that issuer is all dependent upon really what the indications of interest, if you will, that those institutions place, and ultimately the ultimate price at which they sell an offering. And so consequently, deals are, say, 10 times oversubscribed because the institutions are putting these indications of interest, which are non-binding in, and ultimately determine it on terms of where to price it. So what we've done is we said, hey, look, the existing infrastructure of how the securities industry works today, where you have a broker that services that investor's interest. It could be a retail investor, an institutional investor. They have to determine the suitability and what's appropriate for that investor. But they're really they have the ability to put an order in the secondary market, and everybody's on a level playing field, because at the end of the day, it comes down to the price you put in to buy 500 shares of IBM through the New York Stock Exchange, and it's price and time. So why not apply that same methodology to this new issue market? So what we've done, Tim, is we said, hey, look, the secondary market principles are tried and true. Let's follow those same pathways to allow any investor to put an order in for a new issue, call it an IPO. And as those orders are submitted through those brokers who determine the suitability, we populate this master order book, which we then in turn display publicly on our public website for everybody to see how that IPO pricing is coming to market, what the demand is, the ability to click through and look at a prospectus, to look at the roadshow, to coordinate with that advisor of choice. And in the end, every single order that comes in that's being submitted through the existing and participating brokers versus the lead manager is recognized. And in the end, every order that's in the money that's at that IPO price or higher is entitled to a fill.
Mm. So it becomes like an auction in a way.
It's a true auction, and the modification to your point, which is a good observation, call it a Dutch auction. What's the highest price at which you can sell 100% of the shares? It goes back to the 1700s in the Dutch auction. You had a truckload of tulips. What's the highest price I can get to sell all my tulips? It's the same idea here. What's the highest price to sell all the shares? What our algorithm does, and that we now have 12 patents on, is it allows the issuer to say, okay, what's that clearing price to be able to sell 100%? But if we modestly discount an offering price below the clearing price, where there's more demand than supply, that's where this allocation methodology comes in, where if you come in earlier, you're going to get a higher allocation. But if you're in the money, you're getting filled. And that's where every single investor, and it can be tens of millions on a particular offering, can have their order seen, have their order recognized, and be filled based upon that price and that
Yeah.
timestamp that totally levels the playing field for everybody to be able to participate.
I feel like where people, well, a couple things. Before, people felt like, one, if I didn't meet the standards of what was determined as an accredited investor, I don't even have a shot. So
Mhm.
I think that idea that you can place an order as an individual through a broker, and at least you've got a shot at being part of this auction. I think as an individual, going back many years, what people felt also was like, it was kind of an insider's game, right? Goldman Sachs has lots of great clients, a lot of trading partners. And when the hot IPO was coming, they have a certain amount of allocation and they would give that out to people that want to purchase it who were clients or friends of the firm, let's say. And I
Mhm.
think as an individual, you felt like, wow, when it was technically oversubscribed, the oversubscription was everybody that the bank wanted to see get in right early. They got their share. And then the tail at the end of the dog was maybe the individuals at the end, and they never got that chance. So when it was oversubscribed, it was only oversubscribed for that long tail. And I feel like maybe if I'm seeing this right, this really does equalize that opportunity for anybody who wants to participate in the IPO game. Is that true? Am I reading that correctly?
That's correct. And one of the
Yeah.
gets back to you alluded to earlier on, one of the fundamental flaws in the previous efforts, like when Bill Hambrick founded WR Hambrick, and
Mhm.
they did,
Yeah.
some formidable IPOs. They started with Google. I think the biggest one was the Interactive Broker Group. It was a $500 million offering, got sized up to $1 billion, and it was a Dutch auction that Hambrick managed. But the fundamental problem with most all these other approaches was that only a small piece of that offering is being shared and allocated to, call it, retail investors or the non-large institutional players. And still the big institutional players, they determine the pricing at the end of the day. And even with Hambrick's case, where this Dutch auction method was applied, if you don't have every single order being recognized and every single order that is in that order book that's entitled to a fill be allocated some portion, you're really discriminating, and that's what I think created disincentives historically from not only investors to participate, but also the lead underwriters to not want to see some portion of the allocation go to these retail investors or small investors because they would profess that those shares would get flipped back and they're going to create
Yeah.
secondary
Yeah.
market downward pricing pressure. It's not really true. I would say, from my experience, the retail investor is a stronger and more loyal investor for the longer term. It's the institutions that tend to be more flighty because if you price a deal at 25 and it opens at 50, is that institution going to, you know, continue to add to their position at 50? No, they're going to sell. But would they have
Yeah.
been willing to pay 28, 29, 30, 31 to get a larger fill? You bet they would. And would the rest
Yeah.
of the investing public like to see, hey, if I can put a bid in there at 28, 29, 30 and have it be filled, I'm an owner from day one and I'm going to add to my position and be a long-term loyal investor over the term.
Yeah, back in the day, we used to call it IPO flipping, and I think there was that word be oversubscribed. There'd be a lot of hype. I'm not saying the hype wasn't real. I'm just saying there was a lot of hype, so it was oversubscribed. Everybody wanted in, particularly on these tech stocks. The insiders got their allocation shared by the underwriter or underwriters. The price, like you said, what should have been 20 opens at 50 and everybody flips the early people, the allocation, flip it right when the people who are buying it openly, right, on the marketplace. So I'm just John Doe. The IPO happens. I can go out there and buy my share. I'm now buying it at that high price. The flippers flip, make a big profit. The price plummets back down. And then the smaller, we'll call them retail accredited investors, kind of get screwed at the end. That's how I think at least the press talked about the game. I worked for Merrill Corporation at the time, so I was very much working with the investment banks and the lawyers as they were negotiating those underwriting deals in our offices. But I think there was a sense for that, and I always felt that I wish there was a way that individuals could participate early on, instead of kind of getting crushed at the end. Of course, the investment bank didn't really want that either. You don't want to pray. You don't want something to come up and then it booms at the top and then it plummets again. That's not good for the company that's going out either. So I love this idea.
Well, in reality, the underwriters really don't have a great indication of where the pricing should be. These are indications of interest. You tend to
Right.
have, 10, 20 times oversubscribed. I mean, give you a couple cases in point. StubHub went out just a couple weeks ago at 23 and a half, ended up closing at 17. Now,
Yeah.
the CEO said, hey, look, we want to make sure we get certain institutional names in this order book from day one, which they did, but that didn't hold up in the secondary. You look at another extreme on the other end, Figma. Figma goes out at 33, it opens at 85, closes at 115. So it was up 250% on the closing from the initial pricing. But the interesting thing, if you look at all these, and if you go to our site and you look at the IPO data hub on our site, because we have report cards on every one of these, is the number of shares that get traded on the first day of opening. So 36 million or 34 million was the offering size for Figma. It traded 44 million shares. So it turned over almost 150% on that first day, priced at 33, opened at 85, closing at 115. There was a complete reallocation and
Yeah.
redistribution of where those shares ended up at the end of that trading day. And I tell you, it wasn't the institutions that got the privilege to buy on day one.
Yeah.
And like you
Yeah.
said, Jim, it's the people who ended up having to buy in the secondary market at a much higher price. We're trying to narrow that spread and put that profit in the hands of the investors who buy day one, but also not leave a ton of money on the table by the issuers who also are subject to and relegated to this way of the process.
Well, I think also that individual investors tend to be a little more loyal. They probably hold a little bit longer as well than institutions that see the opportunity. They make a big trade, they capture the spread, and then then you've got the zigzag up and down graph on the chart. I'm sure most investment banks, of course, would love to price it at a strong price, but a price that's really at market where people buy and they want to participate and hold it, as opposed to the shenanigans that go on in the first couple weeks or months of that trade.
That's
What I
great.
love about this too is there's this big issue around um, it's not just democratization, but it's about fairness for people that typically don't have a chance to play in the financial game. One of the things that I love about the potential for crypto, for example, is the idea that anybody, an 18-year-old who's got a job who wants to buy $100 of, you name it, right? Your crypto, let's just say Bitcoin, for example, they can do it. They can do it instantly.
Yeah.
They don't have to meet any type of suitability standard. They don't have to be an accredited investor. They can do it in 2 seconds on their phone. And I love that idea of tokenization. Ultimately, we've always thought, well, what if you could tokenize all these transactions? And I talked to Tim Draper a little bit about this idea,
Right.
the idea of tokenizing venture capital, even right.
Hmm.
If you could, if an individual who doesn't even need a suitability standard, maybe there's thresholds, could somehow participate in a venture capital fund, then they would be the first investors essentially in outside of friends and family in that initial capitalization. Maybe was bootstrapped by the founding team. It would completely change those markets and allow everybody to participate. And if you talk about this need for having social equity and fairness for young people, that's really something that I could see happening with technology over the years. But what I love about what you're doing, because so many things have to change for tokenization and that kind of dream that I would have to affect the masses, you're kind of doing something today. So it's not tokenization. You're not going to be the first money in. You're not the VC, right? But at least when it finally does become public, here's an opportunity for you to have an equal playing field and be able to participate as well. And I love that idea. Where are you guys today with the product? I know we talked about you did an initial investment round, was about 12 million bucks. I thought it was amazing. It was crowdsourced for half of that. The other half came from friends and family. It's a large friends and family allocation of that funding round, which shows that a lot of people really believe in this concept, this model that you have. Where are you guys with funding moving forward? And where are you in terms of go to market?
Yeah, so that's a great question. So, fundamentally, we had to build this first, and during COVID really is the time that I just conscientiously said, okay, we're going to go full tilt. We're going to build it. We're going to develop it. We're going to test it. We're going to prove it, and come up with this proof of concept. Now we're in a highly regulated industry because we have to conform with the SEC and get
Mhm.
their sign off, which we have done. In fact, they really embrace what we're doing because we address the investor protection issue. We address the aftermarket volatility issue, the fair, orderly, and efficient markets, and we facilitate capital formation. So all three of the mission statements of the SEC we address, but we had to comply with the SEC, and we have to comply with FINRA because our
Mhm.
revenue model is we get a transaction fee every time a deal gets done. Over time, we're going to license this. We've trademarked securities as a service, ClearingBid SaaS, as a licensing revenue model strategy here, but and that's going to be a function of all the data we gather on what the behavioral patterns are and the preferences are and over time. But back to your question. So we have built it, we tested it, we deployed it, we proved it, and we've done end-to-end transactions between how orders get submitted over the existing secondary market order pathways and how they get settled through depository trust and clearing corp, which is an important piece because this is a same-day cash settlement with DTCC, which is basically a guarantee. So that's going to, I think, eventually, Tim, migrate toward the blockchain and having same-day simultaneous settlement. So we're setting some precedent there. But right now, we're looking at raising another 5 million, between 5 and 10, but say 5 million. That's going to allow us to get to market with our first official deals in the first quarter of 2026. We had our first deal filed in March, but it got pulled because of the market volatility, and that was fine. So we're using this opportunity to re-engineer our back end, how these orders get submitted, and scale it, and be able to do it literally with tens of thousands, if not millions of orders, because no one's really done this before in the past. But the good news is we've already done it, we've proven it, and now we're just doing some refinement. So our intent is to be to market in the first quarter with our first transactions, and we're laying the groundwork with our issuer mandates to do that right now.
When you go out there and you talk with the underwriters, brokerage firms, are they super excited about this? Are they like, wow, this is a problem that we've talked about this as a problem for many, many years or even a decade, and no one's been able to effectively do it? We talked about Bill and what he was trying to do at Dutch auctions online. And is there resistance? Like, obviously been working on solving this. Like you said, it's difficult because it's in a highly regulated industry and it affects people's personal wealth. There's a liability there. What is the general perception when you're going out there and talking to the big players about it?
Yeah, well, the first reaction is you can't do it because it's never been done that way, and it's not the way it works. Because the syndicate desk controls this, and the large firms, with all due respect to the bulge bracket firms, they like it the way it is because they can control it, and it's quid pro quo. This is how quite frankly, a lot of these accounts get paid back and considerations is made. So I respect that. So what we are is we're really a third alternative. And I'd say third right now because I would leave SPACs on the side. But you have a traditional book built method of syndication. You've got direct listings, which have made some strides. And then you've got really our alternative. And we're the best of all, I think, in many respects. But back to your point. So the middle market firms who are going to benefit the most here, and the middle market firms, we've got, like, for example, partnership with Wedbush, who is our clearing broker. But the Wedbushes, the Raymond James, the Stiefels, the Piper Sandlers, all these firms really are relegated to being second class citizens today to the large firms. And so they're a co-manager in some of these deals or a syndicate participant, but they don't really get any allocations. So we're going to move them up the league tables and allow them to do more deals with less risk, with a broader participation, and they're going to get paid equivalent to or greater with less execution risk. So right now, going out and speaking with all those firms, which we have, they're all sitting on the sideline saying, okay, let's see you bring your first deal. So I respect that. On the large firms standpoint, and we've taken it across the boards with everybody. They're not really caring about us until we're relevant. So, but do we go out and do a Freddie Mac, Fannie Mae $30 billion deal? Yeah, we're technically the only way that you could allow all these firms to participate, and any investor, any taxpayer to be able to buy shares in Freddie and Fannie. You can't do it today the way it's worked today because
Yeah.
it's all off the syndicate desk. So I think once we get our first couple deals out there, and we got a couple in the pipeline we're working on right now to bring to market, that proof of concept is done. And then I think it's all over with the shouting, because there really isn't, between the price discovery mechanism and how direct listings work and the underpricing and underallocation and highly exclusionary nature of the traditional way IPOs get done under the book built method, we're superior. And I think these patents are going to be a good benefit to us too. So to answer your question, push back because it's unorthodox, because it's not the way it's been done. And
Hmm.
we've had to engineer this around all the regulatory structural issues to be able to introduce it. Because if you think about it, first of all, the issuer is our client. We're the ones who we get engaged by the issuer, but we have
Right.
to appeal to the issuer. We have to appeal to the underwriters. We have to appeal to the brokers. We have to appeal to the investors, and we have to appeal to the regulators. So it's kind of like herding cats to be able to get out there and do our first deal. And the good news is, we were in market, we were ready to go, but now it's go time. And I think this market environment, it does lend itself well now to capital formation and alternative ways to raise that growth capital. And we're not just an IPO play; we're also in the debt markets, and we're
Right.
going to do, like you said, eventually migrate to the securitization of different asset classes, whether it's tokenization or securitization, and how those get brought to market, because they're still securities for all intents and purposes right now.
I would think, please correct me if I'm wrong, that for the issuer, they probably have to have the buy-in from the underwriter. Like if the underwriter says, "Hey, we could do it, great," but if the underwriter has a resistance, I would think the issuer would just back down and say, "Hey, you guys are the lead. You know, get me to market at a good price and a stable, kind of a stable flow of purchases and selling."
Yeah. So historically, to your point, you're going to say, look, you do your IPO once, don't screw it up. You're not going to be, no one's going to criticize you for having Goldman Sachs or Morgan Stanley or JP
Right.
Morgan do your deal. I appreciate that and respect that. But stepping back and thinking about what we're doing here, we de-risk the transaction, because the same thing happens today. The issuer picks their underwriter or underwriters. They draft up the prospectus. They go on the roadshow. They market the deal. All that's the same. The fundamental difference is that instead of that lead manager controlling who's getting those
Mhm.
allocations and what the pricing is, every other firm on the street has the ability to put their orders in. So the lead manager is doing exactly what they do today. But all these other participating firms now have an incentive and a reason to show up with their client interests, whether it's institutional or retail, and be able to build that order book and then make that ultimate determination as to where to price and ultimately what those allocations are. But we're now bringing many, many more investors, literally millions, to the party to be able to have that price discovery, broaden the reach and participation, and de-risk the transaction. And I'll tell you at the end, Tim, when it's push comes to shove, they're going to realize there's really no better way to do this than ours, because the traditional way is broken and it's opaque and it's highly exclusionary, and the direct listings have no price discovery or ability to modestly discount an offering price from where that clearing price is, which is part of our algorithms and part of the patents and everything else that we have.
So let me ask the question of the moment, which is how is AI impacting what you're doing?
Yeah, it's a great tool because what we're doing right now is we have, the equivalent of these chat bots to answer questions about how do I invest in an IPO and how's the process work. We're coming out with a tutorial video here shortly that's going to address some of these things. But I think the data metrics that we're going to be able to gather on, I call it where the fish are biting, but the behavioral patterns, behavioral preferences, what those queries are, how people are using this as a tool to one, make better informed investments and work with their advisors. Because I think the advisor community out there, I refer to them as a distributed sales force. There's over
Mhm.
600,000 of registered investment advisors and brokers that are going to earn commissions, add assets under management, have reasons for client engagement. And the AI tools to be able to bring and coalesce this information and the queries and the interest that people have in certain asset classes and certain types of securities, or how the educational piece alone. We have this knowledge hub. I think that's going to be huge because people want a agnostic, independent resources they can trust. And that's what we are. We're a dashboard to this pricing tool and be able to bring and bring all the requisite marketing information, offering details to the party, and facilitate the investor universe and the broker universe to allow those issuers to touch them more effectively and able the underwriters to do that in a lower risk, broader, more transparent, ubiquitous fashion.
Yeah, and I think that's where the market opportunity is so much larger than it was, let's say, 10, 15 years ago, because back in that period, to even hear of an IPO, you either had to read about it in a magazine or go to some conference, or you had to have your broker, right, who was maybe it was an underwriter that also had a large number of brokers who were doing that work as well. Then the
Syndicate.
broker would call you up and tell you about an IPO, and I'm with so and so. We're underwriting the deal, and blah blah blah. But just finding out about it was so limited, and then the
Hmm.
information was impossible too. There was no information, right? Except what you were given by a third party, which is usually the underwriter or the broker relationship you have. Today, everybody's scouring with AI and ChatGPT and Grok and all these different LLMs. They're doing their own research. They're literally saying in what are going to be the hottest IPOs, or you could say I want to build an AI portfolio that's crosses each threshold of the ecosystem vertically. Tell me all the upcoming players, and you get so much research that you then go back to the broker in that case and talk to them. But the amount of eyeballs that have potential awareness of this opportunity is going to be magnified. That's just going to get even more so and more so. And once we have a hot IPO market again, and people don't necessarily remember what a true hot IPO market is like, which is not necessarily a good thing. Sometimes it is. It can become too frothy, and then you have the crash on the back end. But I think when we hit that, everybody's going to be doing queries on what this is like, and so I think it's going to really open it up long term. Where do you guys like? What's the next big milestone or two for you? Let's putting funding aside and putting aside the first big transaction. Like you said, the one was canceled because of market timing with the IPO market. Where
Yeah.
do you see that being in maybe a year or two? The big milestones for you.
Um, you know, I- some people say, well, this is kind of a cyclical market, like you said, with IPOs. They come and they go. There's only
Hmm.
3,700 publicly traded companies. I think this is going to open up many more companies to access growth capital. And I think, quite frankly, Washington, D.C., the Jobs Act was one thing, but they're going to have to lighten the load to be a public company. And so whether you're reporting less frequently or the standards for being able to go out and do, an offering, like, for example, a huge hurdle right now is this public company accounting oversight board audit requirement, PCAOB audit requirement for an S1. It's no more longer a gap audit. It's a PCAOB audit. And that's really, really tough for companies. It's a costly and it's very rigorous. So I think Washington, it's incumbent upon them to lighten the load a little bit, to allow companies to access public markets more. And talking about a year from now, I think what we're going to see is a more conducive SEC right now to allowing this with Paul Atkins there.
Hmm.
And, you're going to have whether a Freddie Mac, Fannie Mae goes public or a TikTok comes stateside and wants to go public, you're going to want to be able to allow a broader investor universe to build equity, to build wealth through the opportunity to invest. And I think that's going to be a big movement. So we want to be part of that. And we want to be part of that education and information dissemination to allow this level playing field to truly democratize this wealth building opportunity as we go forward. And that's where I see, the education piece is an important part, and it's
Yeah.
the opportunity and access that's going to drive those opportunities as we go forward.
Yeah, I think you're right on the money with the government regulation side. I was reading something the other day where they're talking about the percentage of companies in the country that have greater than 100 million in revenue that are public is around 13%. So you
Yeah.
think of the overwhelming majority of, I guess I call that a middle market company. I don't think 100 million in revenue is a small company, but you look at the potential opportunity. If you eased on the restrictions and made it easier for companies to go public and tap those public markets for equity, it would open up so many more opportunities. And you combine that with the change in technology, whether it's what you're doing, potentially future tokenization to get into these deals. I think it's going to really open up the capital markets to so many new people. And that's going to be a very exciting time because today, you look at private equity, for example, you look at returns in private equity,
Mm,
unless you're an LP in a private equity or a venture firm, you don't participate at all.
that's right.
And there's so many people that want to because they're, what's the inflation rate is something that people never real we're old enough to remember, coming out of the 70s and then the change under Reagan. And then we basically have had, what has it been since the mid 80s? Virtually no inflation, 2 to
Mhm.
4%, let's say. The last couple years, prior to Trump, when the inflation rate was super high, and it's debatable what the true inflation rate really was, people start to look at, is my return just keeping me at purchasing parity or I'm actually losing money? And so now people are looking at, I've really got to chase higher returns. That's why people are moving away from even fixed income investing because who wants a 5 or 6% bond if the inflation rate's going to be 5 or 6%? So where can I get the best returns? I'd love to get in venture. I'd love to get in private equity, but I can't do that unless I'm a limited partner and accredited investor.
Mhm.
Maybe through public market access with IPOs. If a model like yours becomes available, you can participate in some of those higher opportunities and be not the first into the game, but certainly not the last into the game.
Well, that's why, and we're big proponents of fully registered offerings, the SEC vetted. I think that's a good thing for investor protection because this private market, a lot of there's not a lot of disclosure that goes on with these private company
Yeah.
transactions, these special purpose vehicles that get set up to buy into, the SpaceXs and the Databricks. Those are great companies and they're highly valued, but there's no information dissemination. There's no disclosures. There's no, and so it's really you're kind of speculating there. But in our case, to your point, the ability to open up $100 million IPOs and bond offerings for some of these companies that want to, leverage their balance sheet a little bit more and match fund their liabilities with their assets and be able to tell that credit story to the markets. That's a great opportunity. And I think this is where the brokers community and the advisor community comes in because they can educate the investors, whether it's a self-directed account or it's a fully managed account, you're going to have the tools to be able to do this. And we want to create that conduit to that public market access with greater information dissemination so people can make those informed decisions, but also have opportunity to invest.
How big is your team right now?
We were about 12. We're right now running about 6. We actually probably overhired. I had 4 different law firms we've been working with because again, complicated issues from patents to regulatory issues to dealing with DTCC, et cetera. So right now, what we're trying to do, Tim, is we're trying to leverage this. Back to your point, is go out and leverage the streets marketing prowess, and also some of the law firms who are introducing us to venture firms and PE firms because we can help them monetize these portfolio positions sooner. I mean, when you kind of see what we do, we can size a deal up on the fly because we have that real price discovery and we have the
Right.
ability to have that reach. So we can create liquidity sooner. So we want to go out and be marketing with these other firms and leverage their resources as opposed to hiring more on our end. I need a couple more folks on the equity capital markets and debt capital market side but our technology side is covered. Our platform side is covered. Our regulatory side is covered. So now it's just a matter of getting out and getting these issuer mandates and letting people know what we're doing.
So, from a research standpoint, for anyone who may be listening to the podcast, or they catch kind of the post on LinkedIn about what you're doing, who are you looking to reach? Who can help you right now? What type of companies are those? What type of partnerships? What type of institutions? What type of individuals?
Um, well, the capital formation side, I think a strategic partner is going to be most valuable to us, and someone probably with a balance sheet that sees where we're taking this thing, because it's a pretty revolutionary change in terms of capital formation and what we can do with it, while we're still mitigating risk. But that's one thing. I think on the issuer front, um, some of these sponsors that are looking at ways to monetize the portfolio. You mentioned, Tim Draper. Tim introduced a couple portfolio companies of his. They just not are ready to go public yet, but that was a good endorsement, and I
Okay.
respect him immensely. I think issuers specifically now, a lot of these issuers are going to defer to the investment banks and their advisors as to which direction they want to go. So we've got to continue to work the brokerage side. But my 4 decades of doing this stuff and going out and getting issuer mandates, it's not that tough. But at this point, it's really convincing someone that a different way with which to approach this is actually more advantageous, and that's the proof is going to be in the deal flow. So
Yeah.
I think, back to your question, I think anyone who is an influencer in the boardroom, as an operator or an investor that is intrigued by a better way with which to get to market and create liquidity with greater certainty, that's our universe that and targeted audience.
So, I would think the optimal connection would probably be a certain type of venture capital firm, right? Because they've got the relationships with the portfolio, the issuers essentially. They know who could go to market, who's getting close to market, whether this would be a benefit to them. And then concurrent with that, they could potentially participate in your next round.
That too. But you think about
We
these
call that a
second
twofer.
the two for yeah. But if you think about these 180 day lockups, just digress for a minute here.
Yeah.
Typically, historically, these issuers, they left money on the table and the venture firms didn't care because they were locked up for 180 days. But then all of a sudden the Bill Gurley surface and say, hey, we're leaving a lot of money on the table. We want to be able to get liquidity, and we don't want to be relegated to have to sit on the sidelines until we figure out whether the pricing and who got those shares was the right decision. So there's a big push to try to get liquidity sooner. And that's where we can sit down with these PE firms that, I think some of the statistics, over 25% of the portfolio positions have been 7 years or longer. Or no, sorry, over 50% of the portfolio positions have been there 7 years or longer, and over 25% have been in their portfolio for 10 years or longer. Well, they're sitting around on these positions and they're getting, continuation funds and all these other creative ways to do it. Hey, let's look at the public market and let's figure out how to get you liquidity and really determine the market's demand and what the ultimate pricing and this price discovery solution is to be able to help you do that. And we can do it.
Well, that sounds amazing. Sounds like a win-win for everybody. What's the best way for people to connect with you? Is it an email? Is it LinkedIn? Like, what's best for you?
Yeah, either or. The email is matt@clearingbid.com. So we could try to keep it easy there. And I'm on
Okay.
LinkedIn too. I haven't been that active in terms of accepting a lot of invites and stuff because it's just been distracted. But I tell you, what you're doing, Tim, I think is fantastic. And over the years, as we've been friends and collaborated together, between the headhunting side and where you've taken this business now and really, creating this reach and information tool set, if you will, to your folks that are part of your community there. I think you're doing a great job. So we're really happy to be able to be part of it and be able
Well,
to share some of this
Well,
experience.
well, thank you, Matt. I love entrepreneurs. I love everything about them, their ethos. Um, and our goal in this podcast is to be able to share that story with the world and hopefully connect with those key critical resources that can help you get to that next level, meet that next milestone, and help transform this company. Um, Hopefully, you can underwrite your own IPO one day
That
using
is a
ClearingBid.
strategy, one among few.
That would be the ultimate goal. So that's fantastic.
Like it.
And if anyone wants to reach out to Matt, you can always reach out to me, DM me on LinkedIn, or email me, tim@matchstar.com. And if it's appropriate, I'll make sure I can connect you guys with Matt directly. So, hey, Matt, it's really been great catching up. It's an honor.
You
I'm
too.
so excited to see where this goes. To me, there is nothing more exciting than this transformation that's going on in the financial world and the ability to provide reach and opportunity to the individual, and not just a wealthy individual, but anybody who ultimately can, if they've got $100, if their portfolio is 5K or 500K or 5 million, to have access to participate at least at the level that certain institutional investors and their clients get to during the IPO phase to start. So
Here, here.
appreciate everything. It's been an honor to have you on board.
Thank you so much, Tim. Great to see you, and we'll be in touch. Thanks, buddy.
You too. Cheers.
Bye-bye.
The Startup Innovators podcast is provided by MatchStar Venture Search. If you're interested in any of our executive roles or need help sourcing world-class talent for your company, check out our website at matchstar.com.